All right, day 39 of my journey to a $500,000 stock market portfolio. So just want to go through a trade I made in my RESP. I think it was on Monday. It's actually a pretty good one in my opinion because it was a covered call trade that I did back in October. Here, let's go to orders executed. So this here, MDR. So MDR is, only reason I got into MDR was because of its high premiums. So I got in when it was trading at around $1.56 back in October over here. Not over here, sorry. Over here, $1.58. But I did a cover call trade that only cost me 71 cents to get into the trade. And then the stock went all the way up to $2, $2.35. But my covered call trade, the expiry was May 15, 2020. So even if it went up, it doesn't really affect me because I've got a call option that I sold. My profit usually comes the closer I get to expiry date. So then the stock went all the way up to 2, even higher, but then it dropped back to 160, 150s, and then all the way down to 75 cents, 68 cents as you could see here. And then on Monday, it started trading, it went back up to 175. So I was left with a decision to make. Do I either get out of the trade at $1.15? Remember, I got in at 71 cents. I got out. I had the possibility that day to get out at $1.15, even though my expiry is May 15, 2020. If I wait till May 15, my max profit is 1.5. I can get out at 1.5. That's the most I can get out at if I wait till May 15, 2020. And that's if the stock is trading above 1.5. On Monday, it was trading at 1.75. But I don't trust that stock because as you can see, it went all over the place several times. So I had the chance to get out for a small profit at $1.15 compared to a cost of 71 cents. Plus, I don't have to wait till May 15. So in my opinion, it was a good decision. That same day, the stock was trading at 175. It dropped to 79 cents that same day. Really doesn't make sense. I've never seen something like that same day. So I was very glad I got out of this trade. I think one of those moments where I don't regret taking profits early, because if I did not take profits early, I would have been pretty annoyed. So right now, the positions that's left in my RESP is the Dividend 15 Split Corp, DFN.TO, 500 shares that I bought at 863. Basically, it's for dividends. It gives me a yield of 14% per year. It pays 10 cents a share per month. So it's going to be about $50 per month on this one. So RESP is really long-term, at least 18 years. It's for my children's post-secondary education. But the benefit is I get grants from the government. For every contribution I make, I get about 30% from the government as a grant that can only be used, of course, when the child enters post-secondary education. So I see it as a great way to benefit from an extra 30% from the government to actually put in the market and make a return on. And I've got Bombardier covered call trade. So a stock that I bought, I think at around $2.25. It shows $1.57 because it was in my Investors Edge account, CIBC Investors Edge account, and then it got transferred. And the day it got transferred, the stock was trading at 157. So that's why it shows a cost of 157. But the true cost is about 225. And that's why I keep selling call options at a 225 strike and collect whatever I can collect. But if I have the chance to get out, I think I'd rather get out. I want to clean up my positions, definitely. I want to so I've got a total equity of 83.57 in my RESP, but I want to put it in something long-term. I want to do covered calls, but I don't have enough capital to do covered calls because if I do covered calls, I want to do them on big name stocks and they're mostly too expensive, or I want to do them on the Qs or SPYs. The Qs over 200 and the SPYs over 300. So I'm going to need 30,000 or 20,000 US to do covered call trades on the Qs or the SPY. Even McDonald's I was actually considering McDonald's. I mean, it dropped hard in the last 3 months from 220 to 188 about. And McDonald's has a history of always going up. Even if it drops a little bit, it always goes back up. I mean, the long-term trend is always up on McDonald's. Even the 2009 crash, it's actually, look at this. It didn't even drop that much in 2009. It dropped less than the Qs and the SPY in 2009 than the general market. So McDonald's is actually a great stock to hold because it's almost crash-proof. Here, you don't even see a drop. Very small. But to do a cover call trade on McDonald's, it requires at least 19,000 US because it's 100 shares. Or I could just put whatever I have in my account and just buy stocks of McDonald's. But I don't want to get back to swing trading where you buy a stock and then you just hold it and then wait until it goes up and sell it for a profit. I'm not sure yet what I want to do with my RESP, but still evaluating my choices. In my RSP, so that is also a long-term investment because it's not something I plan on withdrawing anytime soon. I've got covered call trades in them. I think I could have enough to do a covered call trade on the Qs or the SPY. Well, maybe the Qs, not the SPY, or even McDonald's, because I do plan on contributing to my RSP before end of February so that I can get a tax credit for my 2019 income tax return. But for the moment, my covered call trades are on Bombardier again at a $2 strike. I've got L Brands. See, that's one of the problems with covered calls. I bought L Brands at 26, as you can see here, but right now it's trading at 18. So I can't sell a call option at 26 strike. So I'm forced to go at a lower strike of 20. Got 52 cents out of it. But now I'm scared that L Brands jumps up and goes past 20, because then I'm stuck losing my shares at 20 while my cost is 26. So that's always a concern for me. But if it stays below 20 by January 17, then I'm safe. I got 52 cents for free. So I think something I've learned is number one rule of covered call trading is to pick a stock you don't mind holding forever, a stock that you want to hold forever. And while you're holding it, you're selling calls against it for income purposes. But what I was doing mostly with my covered call trading is looking for stocks that had the highest premium and just going in, even if it's temporarily, just to get the premium out of it and then get my money back. But then most of the time, I don't end up getting my money back because the stock drops more than the premium I collected. One good example of that is Grubhub that I bought at 74. I sold a premium of $7. I collected $7 on Grubhub when I bought it at 74. So my cost was around $67, but the stock went all the way down to 35. So what was the point? So even though I collected a good premium, the stock betrayed me. So I ended up selling. Right now, I'm selling a call option at a 50 strike, and the stock is trading at 48.64, and my cost is about 74. So as you can see, pretty dangerous. If by February 21st, if Grubhub is trading above 50, I have to make a decision. Either I put more money in to avoid losing $20 a share, so that's $2,000, or do I just let it go? And I'm just slowly, hopefully creeping up, trying to roll up my call option for a credit every time at a higher strike. That's if Grubhub is going higher. See, I've got this problem with NEO. So I bought the stock at 5, sold some call options several times. Then when it dropped below 2, I sold a call option at 2.5 strike. And then after earnings, the stock is now trading at $4. So look how far I am. I'm about to lose $2.50 per share compared to my cost if I let my shares go at 2.5. And my only choice right now is to buy back for a debit. I need to buy back the call option for a debit and sell maybe another one at a 4 strike to help pay for that debit. But I'm definitely gonna be adding in more money to NEO if I don't want to lose my shares at $2.50. So that's a dilemma with covered calls, or especially with stocks that aren't of the highest quality. So is NEO a stock that I want to hold forever? Absolutely not. I don't really care about that stock. I just went in because it presented high premiums. And so that's a mistake I made, is not picking a stock that I want to hold forever. And I've got Novavax, which same thing. I just went in for the high premiums. My cost is $32. Right now it's trading at $4. My covered call trade is at $8, so I'm giving myself enough room. I was able to collect 35 cents out of it. I've collected a lot of premiums from this trade, but obviously not enough to compensate for the almost 80% drop in the stock. I've got Square here that I bought at 69, but I've collected a lot of premiums. Right now the stock is at 62. My current covered call trade expires January 24th at a 69 strike. And yeah, it's okay. It's not so bad. I mean, Square moves a lot, but I'm not too concerned about this position. I think it'll eventually surpass $69. And I think when it does surpass $69, I don't think I want to stay in the stock. Although I do like the company, I use it. I'm a customer, but I'm not sure what's going to happen. I don't like that indecision, or I don't like that mystery. I'd rather buy something that has a proven track record like McDonald's, Visa, or MasterCard. But of course, doing a covered call trade on them requires a lot of capital. And I've got Yeti that is trading above my strike, so that's good. Yeti's definitely a profitable covered call trade. I've always been collecting premiums on it and never got me in trouble. And I could actually get out at $33 come January 24th if I want. But usually what happens is that the premiums are so good, I just end up rolling the call option at the same strike. So I just keep collecting premiums on Yeti. In my TFSA, got more bad covered call trades. Afria is bad. Bed Bath & Beyond is good. It's trading at 17 while my strike is 12, but my cost is 12.45. So it's a safe one. I just keep collecting premiums as much as I can, but I'm not in a bad position with Bed Bath & Beyond. CHK is bad. My cost is 2.8. Stock is at 82 cents, so that's bad. So the strike that I ended up choosing was 1.5, collected 2 cents times 11 shares. I probably could have used a $1 strike since the stock doesn't seem to be testing the $1. But just to be safe, I went to the highest strike possible where I can collect some premium since my cost is 2.8, so I can't afford getting too close to the current price. I've got FCX that my cost is 11.4, my current strike is 11, and the stock is trading at 13. So this one's definitely gonna get sold at 11 unless I roll the call option at the same strike for a credit, which is what I've been doing. So this one's okay. It's similar to Bed Bath & Beyond, not in trouble. Grubhub, like I just mentioned, is in trouble for sure. Halliburton is okay. It's a good one. It's similar to Bed Bath and FCX in the same position. I'm at a 22.5 strike. My cost is 23. The stock is way above it, but I've collected enough premiums to compensate for this, so it's not in trouble. And I could probably roll it over again for another credit. IMGen was a pretty bad one. Bought it at 5.7. Collected a lot of premiums. Stock dropped all the way down to 2, so I sold a call option at a 3 strike, but now the stock's at 5. So now I'm gonna lose my shares at $3, but my cost was 5.7. So this is gonna be a bad one. So IMGN and Neo are bad ones. I'm gonna end up losing money on them if I let them go at the current strike price, unless I buy them back, unless I buy the call option back for a debit. But I'm basically adding in more money to the trade to save or to avoid losing more money. And I've got Teva. It's an average cost of $15. Right now the stock is trading at 9.8. I've got a strike of 10.5 expiring January 24th. So I keep collecting premiums every month on it. I'm not in a position like Neo or IMGN because stock's at 9.8 and my strike's at 10.5. But doesn't mean that in 3 weeks or in 4 weeks it doesn't jump up above 10.5. But right now I'm safe with Teva, and next month I'll try to roll at a higher strike, like maybe 11. And then finally in my margin account, I've got a few covered call trades, but mostly put credit spreads. So my covered call trades are American Airlines, Box, Dell, Uber, and United States Steel. So American Airlines is similar to Neo and IMGN. I'm a little bit in trouble because my cost on Neo is 30. My cost on American Airlines is 31.5. And as you can see, my covered call trade is at a 28 strike, and price of the stock's at 28. So it's gonna be. I still have a chance to roll it over for a credit because it's so close to my strike. But if it jumps up to $30, I could be in trouble. So I need to make a decision quickly, either to roll it or I could hold on to it and just hope that it stays below 28 come January 31st. Box is safe. I'm down almost $3. I'm down $3 on the stock itself, but I'm not in a dangerous position with the covered call. So as you can see, my strike is 20, and I have until March 20th. So I'm hoping for Box to come back up to 20. It doesn't matter because it's safe for me. Dell as well is safe. 52.5 strike, 52.8 cost. Stock is at 51.3. So I'm safe on that. Collected 73 cents last time. I usually collect around $1.50 to $2, but because the stock was trading at 50 when I sold the call option, I was only able to get 73 cents. And then Uber, this is a bit in trouble because as you can see, my covered call strike is 29.5 and my cost is 40, and the stock is trading above my covered call strike, which means that I could lose my shares at 29.5. which is lower than my cost of $40. So I have to roll this for a credit either at 30 or 30.5, for example, or 31 ideally. So that's or else I'm gonna have to buy back the call option for a debit to avoid losing my shares at $29.5, which would be $10 a share, which is what, 1,000? Yeah, $1,000. $1,000 loss. And I've got United States Steel with an average cost of 18. Stock was trading at 11.4, so I sold a call option at a 14 strike, collected 10 cents, so not bad. Not too worried. I think I'm pretty far from the current market price, so I'm not worried about my 14 strike, which is lower than my cost. So this one's safe, but I'm losing a lot of money on the shares itself. As you can see, $2,700 loss on the shares currently because the stock is trading much lower than my cost. But it's not a confirmed loss. All right, now if I go to my put credit spreads, which is my favorite right now, so I've got Amazon, collected about, I think, $89 on this put spread. And Amazon jumped up to almost 1,900 and now back down to 1,840. So you can see it's at 1847. So this is a profitable position, but just not ready to close yet. It expires January 24th. I've got DIA. I've got 3 DIA put spreads expiring January 17th, January 24th, January 31st. And as you can see, the short strikes, the strike that I need this stock to stay above come expiry date. In this case, it's 280. For the January 17th, it's 279, and for the January 31st, it's 275. So right now they're showing a small loss. This one's showing a profit actually, but not ready to be closed. And this is brand new. Collected, I believe, $60 on that one. But as you can see, I went pretty far. I went at a 275 strike, while the stock is trading at 285. So I gave myself 10 points. I've got 2 IWMs put spreads, one at 163, the other one at 162. Short strike. They're not ready to be closed yet. This one's still break even. This one's showing a small profit, not ready to be closed. I've got 2 MasterCard put spreads, one at 287.5 and the other one at 282.5. This one's showing a small profit. This one's showing a small loss. Obviously not ready to be closed. I've got 2 Netflix put spreads. This one collected about, I believe, $95 on this one, expiring January 24th. It's showing me a loss right now, but my short strike is 300 while Netflix is trading at 323. So I still have a good margin of safety. This one here, I took a 290 strike and I collected, I believe, 85 plus 8, so $93. And I'm 33 points away from the current market price, so somewhat safe. I've got a put spread on the Qs at 208. Right now it's trading at 212 and expires January 24th. It's showing a small profit of $28, but not ready to be closed yet. I could either let it expire worthless come expiry date, or if I have a chance to close the trade early for a profit, I will, just to remove risk from the table. Because you never know, in 1 week it could drop all the way down below your short strike if the market decides to crash or correct itself. So that's why I find that if I have a chance to close it for a decent profit, I should take it. Then I've got 1, 2, 3, 4, 5 put spreads on the SPY. Different expiry dates always. That's something that I've learned. I used to have several spreads on the same expiry date, but different strikes. And that's how I lost a lot of money. Is if the market decides to go past all of them, in that period, I'm stuck. That's why from now on, I decide to have different expiry dates all the time. So January 27th, 22nd, 24th, 21st, 29th, and different strikes. So 319, 317, 316, 316, 315. And right now, the SPY is at 321.8. So they're all safe if the market doesn't crash. But if the market corrects itself, then they could all get in trouble. But they all have different expiry dates, so they all have a different chance of winning or recovering. And I've collected around $70 to $80 on each. And whenever they're ready to be closed for at least 50% of the profit, then I'll close them. So they were showing a profit, but after yesterday, they were not. Hopefully it will recover. Hopefully it will recover in the following weeks. So this one's showing a small loss, small profit, but I've 20 days to go. Small profit with 19 days to go. And this one's showing a small loss with 27 days to go. So I still have a lot of time. I've got 2 put spreads on Tesla, January 24th, January 31st. One at 375 strike and the other one at 370 strike. But I collected a good amount. Well, the first one I collected $75. The second one I collected $1. So pretty good. And the they're both showing, probably they're both break even around right now, but looking at where Tesla's trading at right now for 18, I feel pretty comfortable. Yeah, so that's about it for my positions in my stock market portfolio with Questrade. So if you have any questions, any suggestions on anything you heard or saw, leave them in the comments section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.